are compulsorily has a compulsory requirement to adopt international financial reporting standards. There was an act, Financial Reporting Act of 2011, that gave birth to a new commission that replaced the previous National Accounting Standard Board that we have. We call it Financial Reporting Council of Nigeria. They are responsible for ensuring that all companies in Nigeria comply with the provision of IFRS in their financial reporting. Don't forget, the objective for moving to a more transparent accounting requirement is to make sure that the financial statement prepared by a reporting entity actually represents the true state of financial affairs and is able to bring about what we call uniformity when you compare it with what its counterparts do outside the country. Now that's going to lead us to what we call a transition period. We are going to be looking at a roadmap for the adoption of international financial reporting as an accounting requirement to prepare financial reports in Nigeria. In 2010, there were consultation with 16 members commission. We have the Corporate Affairs Commission, Central Bank of Nigeria, the Federal Inland Revenue Service, Federal Ministry of Commerce, Federal Ministry of Finance, Auditor General and Accountant General for the Federation. We have the Security Exchange Commission, the Institute of Chartered Accountants of Nigeria, and other commission that came together to look at a way of adopting a global set of accounting requirements. And it was actually because of the need to advance the growth and development in the economy. Need to advance what? Growth. Advancement of growth and development in the economy. Now, we're going to be, let's just quickly, before we move at evaluating the transition to IFRS, let's ask ourselves this question: why adopt global sets of accounting requirements? Why do you need to adopt a global set of accounting requirements? Now, as we discussed from previous study, our SAS that NASB issue in the past, this is what we call local regulation. This is what we call local regulation. Then we have IFRS. IFRS, this is issued by IASB that we want to comply with. This is what we call international regulation. The question is, why embrace IFRS? What are the benefits inherent in the application of IFRS in financial reporting? One, the first thing we need to look at is advancement of growth and development in the economy. Advancement of growth and development in the economy. What do we mean by this? If an economy within its national boundary or reporting entity, they do not have obligation more than the activities in that territory, by the time you want to engage in activities across the national boundary, you will be faced with a situation of having to compare your financial report with what your trade counterpart has at that cross-national boundary. For example, if a Nigerian company wants to enter a US stock exchange for maybe as a requirement of being listed in the US stock exchange, for instance, you will be expected to present a global set of financial statements that can be comparable with your counterpart on the exchange. So it might be a little bit difficult. It might be very, very complex for a reporting entity to advance, to grow beyond the national boundary. So when you are looking at spanning your growth across national boundary, application of a global set of standard has a benefit of ensuring that an economy is well equipped to embrace that growth. Another benefit that you have from application of a global set of accounting requirements is what we call transparency and good governance. Transparency and good governance. Transparency and good governance in information disclosures. In information disclosures. As we said in our previous discussion, we said financial statement is meaningless if its contents cannot be easily understood by various users of the financial statement for their economic benefits. So one of the reasons for going to apply a global set of accounting requirements is to be able to promote a system of transparency and good governance practice among reporting entities, so that when you compare your financial statement over time, you will be able to leave a track that your position both at the national level and across international level has been well complied with, has been well covered. It extends your coverage area. So the discussion, the consultative view by this 16 commission came in 2010 when we were looking at how we can embrace the application of these global sets of accounting requirements. In 2010, which is a period of the discussion, we have what we call a transition date, a way of looking at the transition date. If you want to embrace such a standard in such a situation, various reporting entity has to be well prepared. Various structure, because you have been leveraging on existing structure, you have to make sure that you change most of those structure to be able to accommodate the requirement of new standard. So various sensitization program to promote awareness were in place in 2010. Assessment of corporate entity structure and stand in the economy, it was also done to make sure that you change some element of structure and processes that you have. Change of accounting software, change of any other operating software that you might need to be able to integrate your process to give you the delivery that you have. Some certain aspect of legislation will also have to be repealed, because a global set of standards accounting application is designed to be flexible. It's designed to move as situation changes, while by law, the rules and regulation that you have, your law that you have been, the company law that you have been trading is designed to be static. When situation change, except you change that aspect of law, it does not move to address that situation. So if you want to embrace a global set of accounting requirements, you need to make sure that you change some aspect of law that will make it very, very stringent for the application of that accounting requirement to be embraced. So various laws in Nigeria, for example, were repealed. Various laws that give rise to stringent application was repealed. Some were reviewed to be able to make the financial information process to be more embraced. Various training, retraining of staffs was also done to make sure that the knowledge required to be able to, transparently key into this process was also done. And that was done as a preparatory, a form of a preparation for embracing those new set of standards. And that was done in 2010. We also have some planning impact analysis and transaction adjustment that was done during this period. Now, we need to just quickly look at what we call transition dates. We need to look at what we call transition dates. We need to look at what we call the reporting date. The reporting dates. These two notation, they are very key for our discussion of the embracement of the global set of accounting requirement that we are about to discuss. The transition date, because of the various awareness program that has been going on in that was embraced in 2010, every entity will have to reorganize its process to be able to embrace that change. So you will see that between 2010 and 2011 will ultimately be a transition date, a year that every reporting entity is expected to have test run the preparative effort that it has in place to be able to ensure that the conversion is easier. So what happened at the transition date is there are so many transaction adjustments to make sure that your account reflects the new processes. So you would have, according to IFRS 1, first time adoption of IFRS, at this stage is what we call the stage of measuring yourself. We call it transition stage. So after the transition stage, you have an option of whether to adapt or what? Adopt. Adaptation means if you look at the process of IFRS and it does not address your full situation, you can take only the portion of that IFRS that address that situation while continuing with your regulation. But if you want to just comply fully with the requirement of the IFRS without going back, we call it what? Full adoption. So it is at the transition period where you do most of your transaction adjustment that you were able to identify whether the set of global set of accounting requirements address your information need or otherwise. So after your transition date, you are expected to prepare your IFRS opening statement of financial position, and you are expected to prepare your comparative figure. What we mean by IFRS opening statement of financial position is, for example, your transition date is described as the beginning of the earliest period for which an entity is about to prepare a full set of financial statements. If you discover that you are going to prepare a full set of financial statements, for example, if you are looking at presenting a full set of financial statements, for example, full set of IFRS financial statements, if you are looking at 2012, it means you are expected to have a transition period in 2011. Transition date will be 2011. So that transition date will look at a date that you were able to test run most of your processes to produce your IFRS financial report. If an entity has, for instance, 1 January 2011 to 31st December 2011, and you want to prepare your first IFRS statement to be between 1st of January 2012 and 31st of December 2012. Note this: the opening figure that you are going to use at this date is going to be dependent on the closing figure that you have at this date. So the position of IFRS 1 first time adopters, is such that this opening figure must be represented to be IFRS compliance. So it says an entity must present what we call opening statement of financial position. Opening statement of financial position. So it is your opening statement of financial position that would have given you a comparative figure that you can use as an opening figure in this year of preparing your first set of financial statements. So without the opening statement of financial position, you will not be able to prepare a comparative set of figure as at the very first day that you are presenting your IFRS financial statement for public use. But we will still be discussing in our further discussion about how you were expected to be able to prepare a reconciliation statement, both for the transition at the transition date and for the comparable set of first IFRS financial statement that you are expected to deliver to users of financial statements. Don't forget what we have talked about. You need to be able to master what we call the reporting date, and you need to be able to transition date, and you need to be able to know what we call the reporting date. Your reporting date is simply the date in which you prepare your first set of financial statements. Is the latest period to which your first set of financial statements is presented for public use. Other things that you need to learn, you need to be able to learn what we call listed and significant public entity. Listed and significant public entity. Listed and significant public entity. For example, if you see from our transition roadmap that we have identified here, you will see that the first reporting date is for what? Is for listed and significant public entity. It means for listed and significant public entity in Nigeria, they have their transition date to be in 2011, while their first reporting date, which is the first day in which they are going to present their IFRS compliance statement, is going to be in 2012. And you need to understand who a listed and significant public entity are. A listed and significant public entity, they are just simply government entities